Hello and welcome to Rebank. I'm your host, Will Beeson. Edward Woodford is the co-founder and CEO of ZeroHash, a B2B platform that allows companies to embed crypto in stablecoins with a few lines of code and no regulatory overhead. ZeroHash supports companies like Stripe, MoonPay, Interactive Brokers, Franklin Templeton, and many others. In this conversation, Edward and I discuss the most interesting crypto and stablecoin market opportunities in 2024, building digital asset infrastructure, landing blue chip clients, closed versus open source in crypto, and more. Thank you very much for joining us today. Please welcome Edward Woodford. Edward Woodford, welcome to Rebank.
Yeah, thank you for having me.
It is great to finally connect with you on a recorded conversation. We've had a bunch of unrecorded conversations, so I'm very familiar with ZeroHash, your guys' work, and everything you've built over the past, I think, going on 7 years at this point, right?
Yeah, so ZeroHash was founded in 2017. So in crypto years, that's quite a long time.
Well, it turns out that one of the hacks in fintech and crypto, I think, is just if you just keep going, then before you realize it, you're actually one of the older projects in the room.
Yeah, I mean, I think definitely trying to take a long-term view on the space. Fintech is definitely an up and down ecosystem that moves very quickly. The cycles are pretty short. When you layer on top crypto and stable coins, I think that's the power of two. We always say that building in this space, you have to take that long-term mentality and obviously be in the room. But I think, frankly, as well, it's about being very diligent in terms of when things get frothy, you don't overextend yourself. And when things get fearful, you don't apply the brakes too strong. You kind of try to taper the sails versus being overly aggressive. And I think that's what's helped us. And I think that's an important building block for any company in this space where the cycles are so short and where there can be these volatile factors that do change the macro.
Well, the other thing, as an outside observer, that I see about ZeroHash and what seems to me to be one of the large drivers of your guys' continued success over the years at this point is your ability to constantly achieve product market fit. And maybe we can get into that. There was a very beautiful business model that you built at the very beginning of the ZeroHash journey. And as you say, fintech moves fast, crypto moves even faster. And you've continued to, I think, deliver relevant to market use cases. And maybe we can start with one of the things that you're working on right now. I understand that ZeroHash is a core provider to some of the leading tokenization platforms. So there's a big boom when it comes to fund tokenization. BlackRock was in the headlines recently, and I think is at the front of a lot of people's minds with their BUIDL token, basically tokenized money market fund. Franklin Templeton has a similar fund. Benji, asset managers like WisdomTree are also active in the space. You, even if your DNA probably is more cryptocurrency oriented, it seems like you've developed a pretty compelling offering for tokenized fund issuers. Do you want to talk a little bit about that?
Yeah, absolutely. So maybe taking a step back, ZeroHash, we call ourselves crypto and stable coins as a service. So we provide both the technical and regulatory infrastructure to power different use cases. And we sometimes talk about the ZeroHash value stack where we provide three buckets. There's cryptocurrencies as people recognize them, such as Bitcoin and Ethereum. There is stable coins such as USDC, USDT. And then there are fiat currencies, so USD, GBP, Euro. And what we seek to provide is really any combination of those three buckets of the value engine, either together. So that's, for example, fiat to crypto or stables to crypto, and vice versa, right? So Bitcoin to ETH, for example, or what people term FX, right? So dollars to, for example, GBP. So those are kind of the building blocks of our business. And in terms of how those things flow through, we kind of take a view that, and we've taken this view since day one, that crypto is a technology versus an asset class. And that's a really, really important distinction. And so you talk about market fit. Our objective is to deploy this technical value engine, which solves both a technical and regulatory challenge for people globally, and apply this to the application of this technology. And so we obviously started and became very well known for powering a bunch of the leading on-ramps. We've done the same thing in brokerage platforms, such as groups like Interactive Brokers. We've done the same in payment platforms, such as Stripe and Shift4. And over the last 6 months, we've announced a couple of partnerships, such as Franklin Templeton and Securitize. And Securitize is the transfer agent for Biddle. And what we provide there is the same infrastructure just applied to this new market. And so we're really focused on scaling and providing the technical stack for the total addressable market increase that tokenization provides, or for example, that on-ramps provide. And so maybe diving into that tokenization space, historically, there's been this mentality that tokenization is good, crypto is bad. And fundamentally, if you're tokenizing on a public blockchain, that is a false paradigm in the sense that when you tokenize on, for example, Ethereum, there has to be a gas fee paid in Ethereum. And so we provide infrastructure there where we can provide a third-party gas infrastructure for an entity that wants to tokenize on Ethereum, but not, in inverted commas, touch Ethereum. Similarly, one of the value propositions of tokenization is the ability to move these assets 24/7, 365. And there's a limitation of the existing fiat world that you cannot move money 24/7, 365. And so the beauty of stablecoins is that you can do so. And so one of the things that we provide, for example, now to Securitize and their different partners, as well as Franklin Templeton, is the ability to fund in USDC, where that funding happens to a zero hash wallet. It is seamlessly converted into USD. And then that is then transferred to the fund. And then vice versa. If you want to liquidate out of a fund, you can do the same thing there. And obviously, the money market space has grown very, very quickly. I think it's a $1.5 billion market right now, and we're still in a very nascent period. But as you look at broader tokenization, the payment of, for example, dividends and doing that in stable coins and doing it in fractionalization, these things are really, really interesting. And I think is part of that growth in that total addressable market of tokenization.
So that all makes perfect sense in the 2024 context. In the 2017 context, I imagine it probably wasn't as obvious to everyone. At some point in time, you honed in on a specific pain point, a use case that you started to deliver against. Can you talk a little bit about what that was?
Yeah, look, I think no business is a straight line, and maybe in hindsight, we kind of tell a straight line story. But for sure, I mean, Zero Hash was founded on the fundamental principle that regulatory and technical infrastructure in crypto and stable coins is a necessary condition for success. It's not a sufficient condition for success. If it was sufficient, every single partner that we worked with would become the next MoonPay, who we started working with when they were 4 people, for example, and have scaled with us since. So we provide that infrastructure and really lower the barriers to entry. And that's really what motivated us. My first business was a highly regulated business in a different space. It was regulated by the CFTC. And it took us 2 years to get the licenses. And then within 6 months of building out those licenses, which we saw as the North Star, we very quickly realized that we were too early, right? And so innovation in fintech is hard because you have these high fixed costs. You have this regulatory barrier, which is a necessary condition. And so if you can reduce that, not only for startups, but also for large corporations to allow the experimentation in different places, that's really what was the driving factor. And so the story has evolved. So, we power effectively every single on-ramp that works in the United States. The evolution of that story has emerged into, for example, powering some of the largest PSPs to now tokenization. And fundamentally, our view is that this is a technology that will disrupt different spaces. And so another area that we're very focused on is on cross-border remittances. And that's another use case of this technology stack. So ultimately, this is technology that is being deployed to different areas. And obviously, the pace of adoption, the pace of disruption evolves and changes, and sometimes there's false starts. But our objective is to lower that friction to as close to zero as possible, taking on that technical and regulatory stack.
If I try to really distill the essence of Zero Hash's success in my own mind, and you kind of touched on it here recently around the work with tokenized asset issuers, your ability to basically manage the gas. So specifically touch crypto, and they don't touch crypto. And if you roll it back through a series of other use cases that have been popular over time, back to maybe 2019, 2020, around retail crypto trading. Every fintech app consumer fintech app plugging in a crypto wallet. You can buy Bitcoin, you can buy Ethereum. I think of Zero Hash as being a huge force in that phase, basically allowing leading consumer apps who didn't want to touch crypto, didn't have the appetite to wade into what was, still is in many ways, a regulatory gray area. And you basically said, look, we'll touch the crypto. You don't have to touch the crypto, but we can provide the sort of end experience to your customers where they can come in, buy Bitcoin, buy Ethereum, they can trade, they can swap, they can on-off ramp, but you don't have to touch it.
Yeah, absolutely. Don't get me wrong. We view this as a technology versus an asset class, but this certainly is an asset class as well. And some of our largest investors are traditional brokerage firms. So, for example, Interactive Brokers or tastytrade, these are some of the largest brokerage firms that exist in the United States and beyond. And we provide a very, very seamless way. If you go to Interactive Brokers today, and you open up an account, that account is actually powered by Zero Hash. So Zero Hash is the counterparty to every transaction. Zero Hash is the custodian of those assets, and Zero Hash has taken on the legal and regulatory responsibility of the movement of those funds. That's a broader thesis as well. So, for example, we power some of the largest neobanks that exist in the US, such as Moneyline and Current as well. And I think the volume in the trading space continues to grow, especially in the early part of this year, especially with the rollout of the ETF. And that's certainly a big part of our business model. I would say what's been interesting is that point of touching crypto, as you said. I would say maybe when we started, it was, hey, this is complex, this is technically difficult, we don't want to be licensed. What has been interesting, and without going too nuanced, has been, for example, the evolution for these regulated businesses of rules such as SARB 121, which is basically this accounting bulletin that said that if the broker-dealer or a public company is involved in the safeguarding of crypto assets, that you would need to recognize those assets on your balance sheet, which would mean that you would have to collateralize that with cash. So you can see how that becomes a very limiting factor for these types of businesses. So actually that point of touching crypto, I would say that people even more and more want to say, hey, we are not in the flow of funds in any way. We do not touch crypto. We simply provide a front end. And we've been successful in that approach with our partners as well. So I would say that's been the evolution of that brokerage model, which continues to grow. And I think in part it grows because when you look at the numbers that are public, whether it be, for example, Robinhood or Cash App, which is a much more basic consumer experience, these groups are making $200 million plus in net fees and revenue. So it becomes a very attractive proposition for different groups in the US and beyond.
So you, as you've highlighted, are working with some of the leading household name fintechs, but also incumbent asset managers and financial institutions. Given that vantage point, I mean, I imagine you see a lot of data around where the market is right now. What's your sense of the crypto-related use cases that are getting most traction with consumers as of today?
I think obviously tokenization is one which has evolved very, very quickly and one which is certainly getting a lot of attention. Another area where we're particularly well positioned, but also just incredibly interested around, is the evolution of stablecoins and how that can be deployed in different mechanisms, in particular around cross-border. I think the important thing is the customer in itself may not be using stablecoins themselves. There may be this intermediary hop. So one way to think of this is in the same way that most people use the internet, most people don't think about the concept of HTTP. So viewing this again as a technology stack in which the end user is leveraging this technology, but is fundamentally not getting into the nitty-gritty. So if you look at the evolution of stablecoins over the last 6 years, it's pretty incredible to see the evolution. There's been some great reports that have been put out, for example, by Brevin Howard and others, about how much adoption there has been in a short period of time. And when you start to look at some of the businesses that are leveraging stablecoins, I think there's a couple of really interesting use cases. I can share a couple of my thoughts. One is, for example, where the customer is leveraging stablecoins directly. If you look at, for example, payroll and payouts. So if you look at parts of the world like Argentina, where there's a volatile currency, there's a degree of dollarization that is desired in those markets. The desire to hold stable coins is a huge part of that story. So, for example, could you imagine if you have contractors in Argentina or Brazil or wherever, and they wish to get paid in stablecoins? That's one use case where you can see very clearly that there's a real demand and driver. So as you start to think about some of the largest platforms, whether it be Gusto or Deal or Upwork or Fiverr or Uber, you can start to imagine a world where the end recipient is saying, hey, versus paying me in my local currency, pay me in USDC. In the same way that these business models such as Payoneer have been created to support a US dollarization for people outside of the United States. So I think that's a really, really interesting end use case that is growing very, very quickly. And if you look at some of the public statements that have been made by, for example, Deal, they say that 5% of their payouts now are through crypto and stable coins. So that's a real tangible use case that exists there. Another is, for example, leveraging stable coins as a funding mechanism. For example, we've spoken about brokerage. To move money into your brokerage account can take a lot of time. It's costly if you are outside of the United States. So imagine leveraging stable coins as a mechanism to fund your brokerage account, real time, 24/7, 365. And so using that as that step. And then I think you have this remittance cross-border use case with really interesting startups like Felix Pago or Sling, or even if you look at some of the things that MoneyGram has put out about what they're looking to do. And they're actually leveraging stable coins as a mechanism, as a hop. So the customer sends in, for example, GBP or dollars, and the end recipient receives Mexican peso. So the customer experience is really seamless. The customer isn't saying, I'm buying stable coins, but there's this intermediary technical hop, which is allowing for a quicker, seamless, cheaper experience of converting currencies. So I think when we talk about the adoption of, for example, stable coins, it's really important to say, yes, there's certainly customers that will hold and leverage this directly. But there's also this second part of the stack that will be leveraging this and viewing it more as a technology stack as opposed to a transaction-based component.
I imagine that your focus on stablecoins has been more recent than your focus on the traditional crypto business, just because that's the way the market has evolved. Talk a little bit about the economics of the stablecoin business from a technology provider. If you're talking about pure cryptocurrencies, you can see the numbers in a lot of public filings now, but basically the opportunities to make money on bid ask from sort of a market maker capacity, and or just the straight spreads that people charge to end consumers on crypto trading, 2, 3, 5, 6%. It means super meaty economics. And also very clear, to your point from before, that certain types of institutions are comfortable touching crypto, but the vast majority, especially in finance, aren't. Stablecoins seem different in two ways. One, I imagine the marginality is just much lower. There's not the same sort of market-making concept. And in general, if the point is to provide a payments analogous mechanism, I imagine the spreads and the fees can't be tremendous. And secondly, as a, I don't want to say unregulated, but at the very least, much less regulated instrument, stablecoins aren't securities. I imagine there are more people that can play in that space. Can you talk about the stablecoin opportunity for you guys as a business versus traditional cryptocurrencies?
Yeah, absolutely. So look, I think, again, these two worlds, although everyone likes to break them out, they are interwoven in the sense that if, for example, you're transmitting a USDC dollar on Ethereum, there is a gas network fee that has to be paid. And so these two worlds are combined but distinct. And I think that's really important as well, in the same sense that you raise a very pertinent point that when we started, we viewed ourselves as a crypto business. We now describe ourselves as a crypto and stablecoin business. And that's partly because these two things likely will deviate in terms of how they are regulated. So there's, for example, there's a stablecoin bill currently in Congress, which will provide greater clarity around financial institutions touching stablecoins. That will not also extend, for example, holding Bitcoin as a financial institution. And I think the potential customer base that we service, they also have drawn this distinction between stablecoins and crypto. So I think this distinction has evolved recently, despite the fact that they are very much interwoven. So let me go into your question. I think it's a really good one. And I don't know if anyone solved it quite yet. If you look at, for example, Circle, they've adjusted the way that their economic model is working. So there is now a fee, effectively, beyond a certain amount when you burn stablecoins. So the way I like to think about this is to kind of try and draw some parallels to the existing space that exists. So pick your chain. Let's say Base Chain, for example, which Zero Hash just launched recently. Base chain, I would say the chain, or whether it be Bitcoin or whatever, that is much more akin to, for example, a Visa or MasterCard. That is the network of transfer. And there will be many large chains that exist if you believe that payments will be disrupted, because Visa and MasterCard are very, very large companies. So that's the first thing. And then when you look on top, and again, we're just talking just fiat equivalent to stable coins. When you look at then who's building on the Visa or MasterCard, and then Anaglis here, who's building on Base, who's building on Bitcoin, who's building on Ethereum, there are multi-billion-dollar businesses. So stable coins aren't going to be free to transfer when there's a concept of an intermediary that is necessary, but the fees can be significantly less. You're absolutely right that the fees in stable coins are less, in part because it's much easier to understand the concept of fees. When something is $1, you know that if there's a fee of 5 cents, it's much more transparent than if it is a spread that is embedded, similar to stock trading. And so the fee concept, there are lower fees for stable coins. That is just a fact that exists. But I think that the counter fact to that is that the addressable market that exists today is significantly larger. If you look at the remittance corridors, for example, that can be disrupted by stable coins, these are massive, massive markets. Bitso, for example, and Circle have put out that 5% of the US Mexican remittance corridor is leveraging stable coins today. And then when you apply that, for example, we're powering groups that are doing remittance corridors to the Philippines. When you look at remittance corridors down to Brazil, remittance corridors down to Argentina, these are very, very large total addressable markets. So I think, yes, the fees will be less. It's not to say that you cannot create multi-billion-dollar businesses in the same way that in the traditional fiat world, they've also been created. But I think you just have to look at the way that you're looking at the different value stacks slightly differently. I think the number of players will be reduced, i.e. the number of layers will be reduced, and that will help compress fees. But to assume that there's no layers, I think is a false paradigm. So viewing more Visa and MasterCard equals the chain, for example, base chain, versus having, say, 10 other layers before the customer actually receives their funds, I think there'll be 2 or 3. And so naturally the fee compression will occur relative to a more traditional fiat mechanism.
So we talked a little bit about crypto trading, and we've talked about stable coins. Are there other interesting revenue pools that you see in the adjacencies between crypto and finance today?
One that we don't discuss much here in the US is obviously staking. But staking, especially if the ETH ETF passes, will be a really interesting concept and revenue stream that will exist there as well. Obviously, there's a lot of players right now making money through swaps, through DeFi. Those are other levers that exist as well. So I think it's really important, and Zero Hash takes a very global view. We have a very large US business, but we also have regulated entities across the world, in the Netherlands, in Bermuda, in Australia. And so the reality is that most crypto businesses today are doing certain business lines in the US, and then they are doing other business lines outside of the US, taking a much more global view. And there's certain things that most players won't do in the US, such as staking for retail players. But outside of the US, these are very meaningful revenue pools for global players.
What's your vision for Zero Hash in 5 years?
I think it's tied naturally to the disruption of different markets and different verticals through cryptography. We want to be the least well-known, largest player in crypto and stablecoins. And by that, I mean that we provide access to hundreds of millions, if not billions of end persons, either directly or indirectly, providing that infrastructure, both from a technical and regulatory perspective, across the entire world. Evolution places like the Middle East, such as Dubai, the adoption in places such as, I've mentioned Argentina several times. Zero Hash is actually getting registered in Argentina. It's a really interesting economy that is now opening up. Effectively, that's been a closed economy. And the adoption there of crypto and stable coins is already very large. And the ability to move assets seamlessly and immediately, and almost missing a step. So in the same way that when you look at, for example, mobile phone technology in certain parts of the world, some people just skipped certain pieces. And I think that's where you'll see some adoption as well. So our goal is to be a player that provides the global infrastructure to the largest existing companies allowing them to seamlessly move and embed this technology asset class, but also, frankly, power the next 10 to $20 billion businesses that will be created in this space.
How do you think about building a quote unquote traditional software business in crypto versus, say, a protocol or open source infrastructure? Your business clearly takes the form of APIs and connectivity, probably largely to traditional financial services, offline, off-chain parties, and then coordinating that and delivering it via API to solve against specific use cases. Have you thought at all about what the future of your business looks like, the extent to which any sort of protocol type approaches might be relevant in what you're looking to do?
Yeah, we have millions of end persons that we've onboarded into our different entities around the world. And the beauty of our infrastructure is that we can provide a network of networks across different players. And so when we think about identity and around open sourcing different infrastructure, I think that's typically where the conversation starts to evolve. What I mean by that is this technology is disrupting the way that value is transferred globally. Identity is an absolute part of that. And so whether you say this is identity for Web3, which maybe sounds a little tired, but if you say this is identity for the transfer of value in a different mechanism, in a more decentralized manner, I think that's where you start to think about open sourcing. And that's where a lot of players have started to think. For example, TBD, which is the Square company, has thought deeply around this. And I think that regulatory constraints in Europe, such as MiCA, are starting to play as well. So that's where we think about open source. That's where we think about opening this up to be kind of that network on top that anyone can build on top of.
I guess related question there. Your business is very squarely in the transfer of value, much of which is on-chain value. Have you thought about spinning up an Ethereum L2 to basically power a lot of the transactions that you're running, and depending on how degen you are, launch your own token?
So I think token, no. L2s, or even now people are talking about L3s, right? You never say never. I think the key point is that whenever you think about this, you have to be solving a unique problem that you think you are uniquely positioned. So I think the problem with the number of L2s that exist out there today is that there's a lot of duplicative value being created versus additive value. So where's the additive value that is unique enough to be able to solve that problem? Zero Hash is obviously incredibly well positioned when you think about a payment space. If you look at the PSPs that we service, for example, Shift4, Stripe, you look at cross-border platforms that we service as well. If you look at Franklin Templeton, Securitize, Zero Hash is obviously very well positioned. And if you look at the fees that have been created by Base, that is obviously an attractive business model. But I think for us, we're always very, very focused on what do we do uniquely, exceptionally well, and where can we win? And that is always the lens by which we make decisions. But there obviously is a lot of attraction right now. A lot of people are spinning up different L2s. But I think the part that's missing in the conversation is why and what. We're agnostic. So if somebody wants to move value on Optimism, or they want to move value on Arbitrum, or they want to move value on ETH, ultimately we support all of these different technology stacks. And we think that the best technology stack will naturally win. Our goal is to provide that agnostic layer on top, abstracting away the complexity of these different chains. I think that's really, really important as well. A good point that you raised is quite how fragmented this space has become. You know, we've spoken about USDC as if it's a homogeneous asset. It's not. USDC, I think, now can be traded on 15 different chains. So if I'm sending you USDC.ETH and your wallet is USDC.ARB, that doesn't work. And so actually solving this fragmentation layer is somewhere we're much more focused. I don't think there's going to be one winner. I think providing this abstraction layer on top is as equally as important as building another L2. And that's where we're very, very, very focused.
Have you quantified your transaction volumes, annual transaction volumes?
In terms of transaction volumes, you can talk about different metrics that matter to different players. One is obviously volume. That is one that people become very focused on. What we like to focus on as well is on-chain transaction volume. So that for us is actually a metric that we track internally that we don't share externally. We shared a couple of stats a few years ago. During the peak, we were about 4% of the world's entire Ethereum volume for a period of time. So we do track these sorts of on-chain metrics because just providing infrastructure and volume is important, but actually we think that you have bigger impact and you can quantify the impact when you actually look at on-chain volume. And that's something that we look towards. And we hope the conversation can evolve to actually on-chain transaction volume, not only because I think it shows actually importance in the ecosystem, but equally it's also independently verifiable, especially in this space where there's been a lot of different questions about how verifiable these different volume metrics are. I think on-chain metrics are really, really important. And, there are players out there, a number of developers work on different things. One of the things I really like to look at is a dashboard created by Electric Capital. If you look at the Electric Capital dashboard for developers, it shows you this for different chains. And I think that's how we like to think about our business is how many people are building on top of us, how many end customers are being serviced by us, and how much of this total transfer of value ultimately are we powering? And that's the metrics and lens that we like to view our business through.
Question for you as a CEO and leader. 2021 to 2023 was a rocky time, to say the least, in crypto. Seems to me like your business is very much correlated with market activity. I think you guys were either smart or fortunate to raise something like $105 million in early 2022. How did you manage the business through crypto winter? And how do you think about managing a business in a sector as cyclical, at least for now, as crypto?
So we're actually fortunate that the last 3 years, year on year, we've increased revenue, and we will increase revenue this year as well. So we are in a fortunate position. And the way that we've done that is because we have a really good distribution and diversity of customer segment. So last year, trading volumes from our trading customers were down. Those are pretty in line with what you can see on any centralized exchange, pretty correlated. But we have a lot of non-correlated business lines, such as payments, and then also being able to evolve our technology stack to new markets, such as tokenization. That's how we've viewed the business, is viewing this as an agnostic from a vertical perspective and viewing this in a very broad sense of a technology that could be adapted in different ways. What we always say to our team is we take a long-term view and we try to narrow our emotional bounds without becoming unfeeling. And what that means is we don't over-accelerate and we don't become overly fearful. And that is a lot harder to do in practice than it is to say, especially with VCs, especially when others aren't always taking that approach, right? And so we try to avoid the magpie effect of just going to the next shiny thing. We try to take a 5-10 year time horizon to build in a business, but it is hard. You do have to think about burnout. You do have to think about the mental challenge of not only always running uphill, that certainly exists in challenging times, but sometimes it feels that you're actually not only running uphill, but you're actually trying to hold the boulder from coming downhill, right? Just trying to keep the status quo, just trying to stay flat sometimes is really, really hard, especially last year with the blow up of FTX. What that did in terms of changing relationships with liquidity providers and banks and just trying to maintain the status quo was hard enough. So it is challenging. I think just acknowledging that a lot of the time it is going to feel challenging, I think is actually one of the most important things. One of the things that I've got a lot of mental strength from is our board members, from our public board members. So for example, Aaron Anderson, who's Chief Accounting Officer of Meta, sits on our regulated Zero Hash board. And he talks about the concept of liminality, which is this concept of not really knowing where you're going. And that's a place that is very, very uncomfortable for most people. But that's actually where innovation can come from. And so just acknowledging and sometimes just putting a word on a feeling can really help. And in the same way that the good won't always be here, the challenging time also won't always be there as well.
All right. So final question for you before we wrap up. I think one of the things that stands out about Zero Hash is the quality of your customers. Every customer, I'm sure, is an exceptional business, but you have some true blue chip names among your customers. You're powering some of the best known providers in the space. What has enabled you to land such incredible customers?
I think we really tried to focus on substance versus noise. We talk about competition in our company. Just because A is doing something doesn't mean that we should do the same thing. This is not a race in certain areas. If somebody wants to make it a race in certain areas, such as price, that's okay. We'll talk about value. If someone wants to try and compete on loosening of their compliance framework, that's okay. We're not going to enter that space. So I think being very clear on what we are and what we're not is just really, really important. Sometimes I remind our team that we competed with FTX White Label. And, FTX White Label would walk around basically behind us and go up to companies and say, hey, we'll put $100 million. And that actually happened. And we won the RFI, and they would come and they would do that. And we said, okay, that's okay. That's not going to be a long-term sustainable business model. We obviously didn't know the extent to how quickly that would evolve and the ultimate drivers of that. But being very clear on what we are and what we're not, being very flexible, being very focused on excellent technology, being very focused on absolute excellence in terms of our compliance puts you in good stead. I sometimes do this informally. I put every business in crypto into a quadrant. And on the x-axis, it's how much are you actually doing? And on the y-axis is how much noise you're making. Unfortunately, there's a lot of companies that aren't doing very much, that are making a lot of noise. Zero Hash, I think, is not making that much noise, but doing a lot. I think we can definitely make more noise, just to be clear. But I think if you over-index towards making too much noise, I think that actually creates distrust. If you are very focused on building, that really helps. Also, frankly, we've been very strategic in terms of taking strategic capital from different partners who are strong partners for us and who help us become a better business. So these enterprise names have allowed us to become a better business, but also being internally very, very clear. When we close Interactive Brokers, a $45 billion publicly traded company, that is not the goal. That is a stepping stone. What's the next $100 billion publicly traded company? What's the $500 billion traded company? And so always viewing these steps as steps on the journey and how can we be better is really the mindset that has allowed us to slowly go up the stack. Because ultimately, when you look at these enterprise businesses, you can't just go straight to the biggest player. You have to try and build credibility. And that's what we did really, really well. We closed the first $1 billion business as a company. We closed the first $5 billion public. And we closed our first publicly traded company, which taught us a lot. And then you start to combine these different pieces together and you can slowly go up the value stack. And I think that's how we've been able to do what we've done. But we are not done yet.
Incredible. Edward, let me rephrase, you're in the process of building something incredible. I like the way you characterized it as you wanted to be a little known company that powers an entire industry. It's a great way of thinking about it.
Thank you. And thanks for having me on, and looking forward to continue the discussion in different forms.
Edward Woodford, thank you very much for joining us today. Thanks for tuning in to Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.